Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hello Lauren.
Hey Curtis, hey everybody.
Hey Lauren, I know we've had this discussion previously more than once.
Yes.
But as we talk about ourselves as financial advisors or financial coaches, one of the things that we are paid for is to help people avoid great mistakes in investing.
That's right.
And we also are being paid to help encourage our clients to remain disciplined. And one of our pet peeves about investing is market timing.
That's right.
And as previous episodes, we going back to 2008 when we had our last big stock market
catastrophe.
Since 2009, moving forward to this year, we've had a pretty remarkable run of increases in the stock market performance. And this is focusing on the S&P 500, but the interesting thing, if you look at some of our previous videos about this matter, is that for the previous 4 years, from 2009, 2010 through 2011 and 12, there was net outflows from equity mutual funds,
right?
Even though the market was going up.
Right. Yeah. Exactly.
And so, and going into this year, it appears, we still have a few days left in this year,
right,
that we're going to actually have net inflows this year for the first time in 5 years. Okay. Now the takeaway from that is, okay, that's great. However, when I'm looking at, if you break down this year month by month, it's very interesting.
Okay.
What I'm seeing in this article in the Seattle Times newspaper is that if you look at a month by month, people are still market timing even this year.
Really?
Yes. In fact,
the months where it does well, people put money in, and then when it does poorly, oh, okay.
Right. So, Matt, we've finished 11 months this year. Going through last November. We haven't finished this month yet, so I don't have the data for this current month. But in the previous 11 months, even though overall we've had net inflows in the mutual funds, 6 out of the 11 months we've had net outflows.
Interesting.
So what that's telling me is that people or if something's just not feeling right, or we're talking about the sequester, or going into something else, or there's some other situation going on, people are still pulling money out of funds.
That's not good.
So I guess the takeaway from this is market timing is leading people to a path of making a great big mistake.
That's right.
And what's your takeaway from all these years and
months of, I mean, once again, that means a significant portion of investors just missed out on one of the best run-ups that they're probably going to see, because they weren't in the market, so they were actually taking money out of the markets while it was happening. Right. Just too bad. But
and the fact it took the general investing public, and I believe in a previous episode we talked about how little still the public is participating in the stock market.
Right, yeah.
So there's a lot of people that are still sitting out. But the people that have dipped their toes in the market, that tells me they're still squeamish and pulling money in and out. So, I guess in conclusion, what we tell people as this year is winding down, what to do.
Decide what your portfolio needs to be. Decide how much risk you want to take in the long run. Set up your portfolio intelligently, and then stick with it.
Right. And my final thing, and this is the gift that you can take with you into the new year. Use these dips in the market like we're having currently in the month of December to actually rebalance and add to the portfolio. While people are, I suspect by the time this month is over, we'll see a net outflow again, because people are seeing maybe a slight decline in the portfolio. So use this time to actually go against the contrary to public opinion and buy into the dips in the market. Right. Thank you for watching this episode of Erickson TV. We'll see you next time. Bye.
See you next time.